Are you or someone you know looking to buy or sell a home? When you use a HomeGain Realtor to buy or sell a home, you can get $150. Visit HomeGain.com and click on the Promo 150 banner at the top of the page to get started. Compare HomeGain Realtors and choose your favorite. Complete your home purchase or sale transaction with a HomeGain Realtor, and HomeGain will pay you $150. Get started today by going to HomeGain.com. Welcome back, everyone, to Real Estate 360 Live. I'm your host, Ryan Sloper, joined today by my guest, Louis Cammarosano, the general manager of HomeGain. Quick reminder, Real Estate 360 is designed to build the Washington, D.C. Metro's housing and credit markets one house at a time. If you ever have any questions, concerns, or real estate needs, the best number to reach out to us is 877-245-2030. That's 877-245-2030, or via the web at realestate360live.com. That's realestate360live.com. We're going to jump into this week's market movers, which kind of gives you an indicator of what's going to happen this week that could actually shift interest rates up, maybe let them come down a little bit more. And this segment was brought to you by HomeGain. HomeGain is the place to get you started buying or selling a home, finding a realtor, and getting real estate questions answered. Go to HomeGain.com today to see what I'm talking about. All you have to do is type in your home address, and you'll get an instant free estimate of your home's value online. It's a great way to monitor your home's value, and it's totally free. When you guys get a chance today, check it out. It's HomeGain.com. So we had today, actually, Louis, we actually had retail sales, which actually came in a little bit hotter than expected. I believe they were expecting an increase of 0.3%, and it was actually 0.8%, which the biggest jump in the retail sales was home building and car sales. The biggest jump was the 3% rise at building and garden supply retailers, which I think that we had mentioned this in a previous show as well, Louis, that, we had the first 3 months of the year was probably the warmest that we've had, across the country, which I think could be a big reason why this number would come in a little bit hotter than expected.
It doesn't represent a trend. It represents consumers responding to the weather rather than to economic circumstances. And they go out and they buy a rake or something for their garden because it's warm.
Exactly. And that's more or less what when the market first opened this morning, it kind of jumped out. The stock market, was going up a little bit. Rates were kind of, not doing too much. And now I think it's leveled back off. Stock market's pulling back a little bit. So, this isn't, monumental news or anything like that. This jump in retail sales wasn't even that substantial anyway. But
also they don't take into account that if prices rise, then people spend more.
Sure. Yeah.
Inflation included in that. They spent the same amount in general to get the same amount of goods, but they spent more money to do that. So the cost, the spending looks like it increased. Consumer spending looks like it increased, even though they actually bought the same amount of goods as the month before. Yeah,
I mean, because the cost of rising oil prices and everything else is going to be passed down to the consumer. That's the first thing that pretty much has to happen. I definitely think that's what's going on there. Also,
and besides, Ryan, just because people spend a little bit more money, even because prices went up or they borrowed money to do so, that's not the sign of a healthy economy. You would be happier if employment rates went up, savings rates went up, investment rates went up, not because people went out and spent a little more money.
Yeah, that's definitely, I agree with you 100% on that. And it seems like, the Fed, I believe it was Friday that Bernanke was speaking, and he came out and basically made comments to the effect of that
I didn't even want to mention this because go ahead.
That the Fed needs to focus just as heavily on its regulatory role as it does its monetary policy operations. And
as if they haven't done enough damage in the first role.
Right. I mean, okay, so you've basically been crushing, the entire country with your monetary policy, which now it seems like, and from the more and more of the stuff that I'm reading, it seems like that the markets are putting extra pressure on the Fed to come out and say, yes, we're going to continue easing. I don't understand it. I don't know why we would want to continue doing this. If anything, we should be working through this problem. I don't think that we need to add more money, inject more money into the markets. At this point, the banks are borrowing money at next to nothing. Until we can have employment pick back up, until we can start getting these banks to start lending to small businesses again, And, the small businesses have to be thriving enough to want to take on these new loans as well. I mean, it's not just a one-way street. But now all of a sudden the Fed wants to come back in and really start regulating. And the interesting thing was too, Lewis, was that he made mention of that one of the ways that they were doing so were with these the bank stress tests. Well, that's great, but you were doing bank stress tests at the low levels of interest rates of somewhere close to 0%. So how does that give you an accurate reading of the current valuation of a bank's assets when we have this low interest rate environment, which is an artificial, these are not real interest rates where
they're
at
not
right
market rates, and
no.
they assume that their assumption is they'll remain low, not artificially low, but in their mind, somehow the market will keep interest rates low to allow them to achieve their projections.
Yeah, so that's one of the ways that they're regulating, and I'm curious to find out what some of these other ways he didn't mention, but the other ways that they'd like to start regulating. I mean, as if they don't have enough power.
Well, they've also mentioned, and Bernanke mentioned again, that the subprime mortgages and the housing bubbles were not the cause of the crisis, as if somehow their actions to create the housing bubble by injecting cheap liquidity and having low interest rates and having government policies designed to put everybody in a home somehow didn't cause the bubble.
Right, and there was also...
And also, they didn't see it coming, and now he's saying, but we had nothing to do with it.
Right.
So give us more power to regulate now.
Absolutely, and he also had mentioned, he was asked a question, I believe it was from a Harvard professor, Princeton professor, of, did he believe that Alan Greenspan's low interest rate policy over an extended period, if that had anything to do with the bust that we had in the housing market, and he said there's not enough evidence for me to think that. Well, I can tell you that it definitely didn't help things. Evidence
under his nose, he's only going to see what he wants to see.
Sure.
I mean, he's the guy who said if inflation were to rear its ugly head, how confident would he be on a 60-minute interview about a year or two ago that he could stop it, which is already an absurd question that one person can stop it.
Right.
He said 100%. I mean, there's a lot of hubris there that one man thinks that he can basically stop inflation in an economy because of its position at the Federal Reserve. Granted, the Federal Reserve is powerful and it does control interest rates and money supply and credit. However, I don't think it can control the entire world economy just because it wants to.
Yeah, I guess that they think that, and these are like the backroom negotiations and everything else that goes on that we're not privy to. But it's almost like, Wall Street and the Fed are almost like say, okay, this is what's going to happen if this happens, and we're just going to inject more and more money. I mean, at some point they're going to devalue the currency to the point where one of these other powerhouse countries are going to say, look, we need to really start making a push to move the U.S. dollar as a reserve currency.
They have to, because all money it represents value, that people believe it has that value. And once faith is lost in a currency, it's lost forever. You always make the point that no fiat currency has lasted more than 50, 60 years. I think it's even 40 years.
Yeah. And I mean, it becomes extinct and it has to change. It has to turn into something else, whether it's backed by, a commodity basket of goods or gold or silver. But that's coming. At some point, they're going to be forced to say, all right, you guys can't just continue to print, because that, how are we ever going to be guaranteed we get anything out of this deal?
And the only reason that we're able to get away with it is there's turmoil in all the other fiat currencies.
Right. Yep.
I mean, you keep having European crises. Even today, I don't know if you saw it, just at the wire, Argentina decided to nationalize its oil industry. Now, you could say that's no big deal, but then you have to realize that Spain probably has big interests in that, and they're probably just going to lose those interests because the government took them away from them.
Yeah.
What's that going to do to the finances of Spain, who's
right.
already in trouble?
Yeah, and it's like, and that's why I almost feel like the United States, where, we're able to continue delaying and kicking the can down the road because there is all this other stuff going on in Europe, in the Eurozone, that allows us to continue to do so.
And the mindset, Ryan, of investors is when there's trouble is to put your money in U.S. Treasuries, not to go out and buy assets or another currency. And that's why really the gold and silver market are relatively small and represent a very small percentage of the investable assets. Most people prefer, when there's a crisis, to put money into either U.S. stocks or, if things are a little riskier, into U.S. Treasuries.
Sure. And I mean,
that creates a demand and it keeps the interest rate down a bit. But we also know that the Fed is buying 61% of the Treasuries, so it's not like investor demand is keeping these interest rates low.
Yeah.
Even though there is some when there's these kind of crises that prop up.
But the average investor, the average Joe that's got money in a 401k or anything else is probably not necessarily paying attention to what their money's tied up in. But the fact that the Fed's buying so much of the actual treasuries is enough reason for me to say I don't want my money in there.
Well, what's also strange is not only is the Fed buying much of them, it's that they are making up for the lack of buying in recent years of China and Japan.
Right.
If you go back 10, 15 years, China and Japan did not make up the bulk purchases of the U.S. Treasuries, nor did the Federal Reserve.
Sure. And at this point, our debt is increasing at such a rapid pace that,
They have to buy it because if
right.
Congress keeps increasing the budget and goes into a greater deficit, that's financed by purchases of U.S. Treasuries, which are bought by the Fed.
Yeah, and I believe it's, I think it's next week the Fed will meet on Wednesday with their policy statement that's expected to confirm what the Fed is actually thinking about its previous meeting's policy statement, that there really wasn't any mention of another quantitative easing 3, whatever you want to call it. But it'll be interesting to see which way things go next week. Once again, this is kind of an alert to all you guys out there listening. If you're trying to obtain a mortgage at this point in time, you're trying to determine what you're going to do with your interest rate. I always advise people when you have a big event like the Fed that has such power that we're discussing right now that can manipulate markets the way they do, that you don't want to risk going into next week and floating your rate through next week.
Anything could happen in general. We have been wrong that we think interest rates would have gone up the last couple of years.
Yep.
But they really, while they haven't really gone down that much.
No.
We've been saying once they go up, they will shoot up.
And then every time we get back near that record low, it seems to bounce. You know what I mean? You get that like one or two weeks right at that record level, then all of a sudden it's like we get some sort of good news that stock market's thriving again, and boom, they're right back up again. So, it's not going to be one of those things I think where a lot of people think that they're going to get down to 3%. I wouldn't bank anything on that. Make the smart play here. If you're floating your rate out there, at least just look at with the economic data that you guys have and make a decision based upon that. But with the Fed meeting next week, I say it's probably a good idea that you do something with that rate lock. We're coming up on a break. When we come back, we're going to discuss what it actually means to work with a real estate expert and how do you know you're working with one when we come back.